Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is BS 251. This is our lecture number 26, and the topic for today's discussion is cost of equity approaches and the weighted average cost of capital, which is written as WACC. Basically, this lecture is in continuity to my previous lecture, which was lecture number 25. So I strongly urge to the listener of this lectures to first listen to my lecture number 25 so that you may be able to grab the basic idea and crux of this lecture thoroughly. Let me revise a little bit before starting this lecture that we have learnt about the cost of capital, in which particularly we have discussed the three main sources of finances named as the debt finances, where the company issue the bond instruments to the prospective investors in order to raise the capital for the prospective proposals. Secondly, company can also issue the preferred stocks to generate further finances or capital, over which it has to pay certain charge or cost to bear. Thirdly, the company can issue the common stocks to the general public for investment purposes. So the issuance of the common stock is requiring a little bit complex techniques to calculate its cost of equity. So therefore, basically we had started to discuss about the different approaches to measure the cost of this equity portion or the common stock. So basically in that we got three main approaches. So the prime outline or the discussion of this lecture will address the remaining two equity approaches to measure its cost, because the cost measuring for the different sources, that is debt, preferred stock and the common equity, is really crucial in order to reach at the weighted average cost of capital or the overall company's cost of capital. The first agenda of this lecture will be to discuss the second approach of equity or the cost of equity measurement. The first one was the dividend discount model, or we can say the cost, and we have taken the assumption of a constant growth model in which we have calculated the cost of equity by using the constant growth model, which was the dividend discount model. The second method is to use the capital asset pricing model technique to measure the cost of equity or common stock. And thirdly, we have the before tax cost of debt plus risk premium approach to measure the cost of equity. So therefore, the first agenda of this lecture will be to discuss the remaining two equity approaches for measuring the cost of equity in detail. Finally, after having the cost of debt, cost of preferred stock and as well as the cost of equity, we are able to measure the overall cost of capital of the firm, that is to measure the weighted average cost of capital. So the primary focus of the corporate sector are a legal form of business organization which is named as a registered legal company. The weighted average cost of capital does matter a lot. And on the basis of this weighted average cost of capital, normally the company utilize this rate for judging the or examining the prospective proposals of investment, so that to either to go for investing in those proposals or to reject those proposals on the basis of one of our old friend, a technique named as net present value mechanism. So for calculating the net present value of prospective projects, this weighted average cost of capital, which is the overall cost of capital rate of the company, is utilized normally for examining different prospective investment opportunities. And out of those investment opportunities, the one which got the positive net present value shall be selected. Final agenda of our lecture will be to discuss the economic value addition. As you can see, this chapter has started to discuss about creating the value for the shareholders, and we know very well that the overall main goal of the company is to maximize the shareholders' wealth or value. So therefore, the company is normally interested to know about the charge of the capital and as well as what type of economic value has been added into the shareholders' wealth. Let's move to discuss this agenda one by one in detail. So here comes the second approach of measuring the cost of equity, named as the capital asset pricing model. Now, what is it? What is it all about? It is related with a security market line that will explain the risk and return relationship that will enable to measure the cost of capital or cost of equity for the firm. The cost of equity capital is usually denoted with KE in this approach, and it is equated to the required rate of return in the market equilibrium. Now, what does it mean? It means that the risk and return relationship is described with the help of a security market line. And what is this market line all about? Mathematically, we can write down this security market line like KE, in which we are interested to find out the cost of equity or the common stock by using the capital asset pricing model. We have referred KE with RJ. This RJ represents the required rate of return on the jth stock of a particular company. Like for example, we are assuming that the company name is J, so therefore the stock of this company or share of this company will also be referred to as J stock. This RJ is referring towards the required rate of return on the J stock of the J company. So what the investor usually require is the risk-free rate, like why one should invest in your company's stock to bear the company specific risk factor, because the company may default in the future and all of the money invested in that could be gone. So there is certain risk-free rate available in the market for all investors, which is usually provided by the government securities like treasury bills and treasury notes. So if somebody is going to invest all of his money into the risk-free rate investment opportunities, that is either to go for a fixed term deposit in the bank or go for the government treasury securities like treasury bonds and notes. So those kind of investment opportunities certainly provide us the risk-free rate because there is no risk factor associated with such kind of investment opportunities. So when somebody is looking to invest in a particular company's share, so in that case, that investor is usually expecting the return in excess to the risk-free rate. So what is that excess amount of return? So that has been mentioned as plus into the R bar subscript M. This is referring towards the expected return of the market. Now what does it mean? It means that let's suppose you got $100,000 and you would like to invest this $100,000 into complete market. By complete market, we means that let's suppose if there are 100 companies listed on a particular stock exchange, and you have $100,000 to invest your money into this 100 companies stock proportionately. So in that case, you are required, or you will be looking to invest $1,000 each into these 100 companies listed on the stock exchange. So when you are investing in all of the markets company, you are actually diversifying the risk factor, and therefore the complete accumulated return what you will receive or you will realize at the end of a particular time period will be your market return, because you have invested in full markets companies and full opportunities. This is basically the expected average rate of return if the investor is going to invest his money proportionately in all the available opportunities. Finally, we have to subtract the risk-free rate from the market rate, which is market expected rate. So this resultant excess amount of return what the investors requires usually from a particular company's stock is known as risk premium. This additional amount what the investor is looking to earn by investing into J company's stock is known as the required risk premium. The final notation, which is beta subscript J, is referring towards the systematic risk of the company's J. So when you are investing in a one particular company which is named as J, so there is particular systematic risk involved if you are looking to invest your money in this particular company. So this systematic risk is actually what the investors require the risk premium for. So this complete expression will further be elaborated with the help of a mathematical example, which will make you enabled to understand the capital asset pricing model and how to calculate the cost of equity of any particular company by using this formula. So here we have a determination of cost of equity using the capital asset pricing model, and we have a numerical case over here. Let's read it out. Assume that the basket vendor, which is a company form of business organization, has a company beta of 1.25. When the beta of any particular company is above 1, it means that the investor who is looking to invest in this company will definitely require the risk premium or the extra amount of return by providing or investing their precious money into this company's stock. As we know that the beta of this company is well above the threshold level of 1. So therefore the risk, there is a systematic risk involved while investing your money into this company. Secondly, the research by the Julie Miller, an investor, who suggests that the risk-free rate in the market is 4%. Like if somebody is not interested to take any kind of risk, then they can invest in the government security and can resultantly earn 4% return at the end of each year. So if somebody is not interested to face any risk or a risk averse investor, so he or she can simply go to the government securities and can invest in that security and earn the risk-free rate of 4%. Let's move ahead, and the expected return on the market in this case is 11.2%. But if some investors are looking to bear certain kinds of risk, and they are risk-taking investors, so they are quite professional enough to diversify their risk by investing their amount on the basis of pro rata basis in all of the stocks available into the market. In that case, the investor can earn 11.25%. So now we are in a position with relevant data to utilize the capital asset pricing model to calculate the basket Wonder's cost of equity. What is that? KE is equal to the risk-free rate plus the risk premium, which is the expected market return, minus the risk-free rate into the company's beta or systematic risk factor. Plug the data as the risk-free rate is 4% as given in the numerical case. The market expected return is 11.2%. Risk-free rate is 4%, and the systematic risk involved while investing into the basket Wonder is 1.25. With the help of simple arithmetical operations, we come up with the KE, which is the cost of capital, as 13% for this basket Wonder. If somebody is interested to invest his money into the basket Wonders share, then at least this company must pay 13% required rate of return by the investor. Otherwise, they are going to lose their money. So this is the way we can use the second approach to calculate the cost of equity capital. Let's discuss the third and the last approach towards the calculation of the cost of equity or common stock. This technique or this approach is named as before tax cost of debt plus the risk premium approach. So what is this all about? In order to measure the cost of equity with the help of this approach or procedure, we have to look at the company's before tax cost of debt, which was rather denoted with KD, and along with that percentage, the company usually, typically or normally add up some risk premium so that to make their common stock more attractive to the prospective investors. So this could be either 3% in addition to that KD are named as before tax cost of debt, or it could be 5%. So this is actually the risk premium which is usually required by the investor if they are looking to invest in your company. The reason is that the debt instrument or the opportunity to invest in the company's bond is less riskier than to put your money into the common stock of that particular company. So in that case, when the investor is looking to bear an additional risk factor which is involved in your company to invest their precious money, therefore the company usually offer an additional or excess percentage or excess amount of return to the investor as risk premium. The competitive advantage of this approach is that one does not have to know about the beta information of that particular company. However, at the another side, there is one potential disadvantage, that is, it does not allow for a changing risk premium over time. Like with the passage of time, the market condition can vary. So therefore, the risk premium could be increased or could be decreased later on. So here in this mechanism, the cost of equity once again is referred to as KE, is the sum of before tax cost of debt plus a risk premium in the expected return for the common stock over debt instrument. Mathematically, we can write down as KE is equal to KD, which is cost of debt, plus certain risk premium, which could be a subjective matter. And this risk premium is offered to the prospective investor in order to attract them to put their money into our company's common stock. So this risk premium is not same as that was used in the CAPM risk premium method, because that risk premium mechanism was a sophisticated technique. Let's determine the cost of equity with the help of before tax cost of debt method. So we assume that the basket Wonder typically adds 3% premium. Their policy is to offer 3% premium to their cost of debt. To what? To the before tax cost of debt instrument. So what could be the cost of equity in this case for the basket bonder? So it's quite simpler now that the cost of equity KE is equal to KD plus risk premium. We know that the cost of debt, as discussed in our previous lecture, the cost of debt for the basket bonder was 10%, and the risk premium they generally offer to the investor is 3%. So therefore, the final cost of equity under the third approach, which is named as before tax cost of debt plus the risk premium approach, is once again 13%. So these are the three methods with the help of which we can calculate the cost of common equity of the firm. Let's compare the cost of equity methods. We had three different approaches to measure the cost of equity of the firm or the company. The first one was the constant growth model. It come up with 13% of cost of equity. The second method as discussed in this lecture is capital asset pricing model. Once again, the company's cost of equity come up with 13%. And finally, the third approach, cost of debt plus risk premium approach, has also come up with the same 13%. However, this was a hypothetical example we have taken to understand the different approaches used to measure the cost of equity in an organization. But normally or in principle, these three methods will not coincide or will not agree with each other. Rather, these will give you different results because these involves different techniques to measure the cost of equity. Now, a question arises over here. What is the basic purpose of finding out the cost of each of the sources of finances that we have discussed in this lecture and lectures number 25? That is, what is the need to find out an individual cost of debt and the cost of preferred stock, and similarly the cost of equity with the help of three different techniques? The answer to this question is to come up with the weighted average cost of capital. This weighted average cost of capital, or simply we listen from the people speaking the WACC, or a total and or an overall cost of capital of the company, so that we know that the blend and mixture of the three different long-term financing has cost us what percentage. So weighted average cost of capital is actually the proportional weighted average of the three main sources of finances. How to calculate that? This WACC, or a cost of capital of the firm, we have to sum up the x starting from 1 to n. Here x is referring towards the sources of finances we have used. Let's suppose if the company has utilized only two sources, that is the debt financing and the equity financing, then this x value will be 2. However, if the company has used three different sources of finances, that is debt, preferred stock and the common stock, then the x value will up to n will be 3. Here we subtract x is referring towards the weight of a particular source of finance. That is, let's suppose if the company has generated 30% of its capital from debt, 20% from preferred stock and 50% from the equity, then the weight of debt will be 0.3 or 30%. The weight of preferred stock will be 20%, and similarly the weight of common stock will be 50%. And this kx is referring towards the relevant cost of that financial resource. Like if it is a debt instrument, then the weight of the debt instrument, which is 30%, will be multiplied with the cost of debt, after tax cost of debt. Similarly, the weight of preferred stock will be multiplied with the cost of preferred stock. And finally, the weight of the equity, which is 0.5, will be multiplied with the cost of equity. And at the end, all these three resources must be summed up in order to have the weighted average cost of capital. Let's see how to do that shortly. So here we have our weighted average cost of capital, and we knew that initially the company was looking to finance or generate 35 millions from the debt instrument, 15 million from preferred stock, and 50 million from the common equity. So how did we calculate this weight or percentage? 35 million divided by the total capital raise. It has given us 0.35 as the weight of the debt instrument in the total capital structure of the company. Similar method is used for preferred stock and then for common stock. Starting with the common stock, its cost of equity come up with 13%, as we have seen for instance before, and in the previous lecture we have calculated the cost of preferred stock as 9%, and the after tax cost of debt was 6% for the debt instruments. So therefore, with the help of simple mathematical arithmetic operations, we come up with the weighted average capital of 0.0995, which after multiplying with 100 has given us 9.95%. So what does it mean? We can finally give a verdict that the weighted average cost of capital, or the overall cost of capital for the firm by utilizing the three different sources of finances, is 9.95%. In other fashion, we can say that on average, company is paying 9.95% of charge for utilizing the three different long-term financing sources, that is debt, preferred and common equity. This weighted average cost of capital is normally used for finding the net present value of the investment projects, what we have discussed in capital budgeting techniques. So this 9.9% will be applied on the different prospective proposals, and if the net present value is positive, those projects will be accepted because those projects are creating value for the company, and those projects are actually creating or enhancing the shareholders' wealth. Now, what are the limitations of this weighted average cost of capital? Number first is the weighting system. By weighting system, we mean that the marginal capital costs are unknown to the financial managers. Like in future, the marginal capital cost could vary. Like for instance, before we have calculated the cost of equity as 13%, the preferred stock was 9%, and similarly, the after tax cost of debt was 6%. But those can be varying or changing over the period of time in future, so that will require an additional work to calculate the WACC each time. Secondly, the capital raised in different proportion than that of the weighted average cost of capital. Like for example, certain projects requires to be financed totally with the debt instrument. The others might require totally to be financed with equity portion. In that case, the proportion of the WACC could be varying and different, so it can have a potential problem for the WACC to be utilized as calculating the net present value or doing the capital budgeting uh, procedure in your company. Secondly, another limitation of the weighted average cost of capital is the flotation cost. By flotation cost, we mean that each time we are offering the common shares or preferred stock, or even though we are offering the bonds to the general public, those normally require certain amount of money for issuing those security to the general public. So what is the flotation cost? It is a cost associated with issuing of the securities. Like, it's not a free of charge to issue your common shares or bond, because you have to pay certain fees as underwriting to the bank or any other underwriter. You have to pay the legal fee to the lawyers, listing fees if you're listing your shares somewhere, and finally the printing and other additional fee. So this additional flotation cost requires you to have certain adjustments in order to make this weighted average cost of capital as a technique to utilize for capital budgeting, to use it for calculating the net present values. What are those adjustments? Adjustment to the initial, you have to either adjust your initial outflow or you have to adjust the discount rate. How to do that? Let's look at them shortly. So first technique is to adjust your initial outflow or outlay, sorry. You have to add this flotation cost to the initial cash outflow in order to reach or find out your net present value for a prospective project in order to be accepted. The rest of the mechanism for calculating the net present value is same, that is, you have to discount each cash flow until the project end, and to calculate the present value of future cash flows, as we have also discussed in the time value of money chapter. If you would like to have more details on that, you can look into my channel and you can listen to the capital budgeting lectures, and as well as in the time value of money we have discussed how to calculate the present value and net present value of a project. So the normal method to calculate net present value was to subtract the initial cash outflow from the present value of future cash flows, but here you have to add up the flotation cost into the initial capital outflow, because this is your actual initial cash outlay. What will this flotation cost, what kind of impact this will have? It will definitely reduce your net present value. So it will make more stringent requirement for a proposal to be accepted. Second method is to have adjustment to the discount rate, that is, subtract the flotation cost from the proceeds what you have received from the issuance of the security, and then once again you have to calculate the yield figure or the required rate of return. So you have to subtract, let's suppose if you have issued $100 million of securities and you have paid only $1 million of flotation cost, let's suppose. So the resultant leftover amount will be 99 million, which can be utilized in your company. Once again, the impact of this adjustment will increase the cost for any capital component with the flotation cost, and resultantly it will increase the weighted average cost of capital, which will definitely decrease the net present value of any project. So the flotation cost has impact on your net present value, what you have to adjust in either the discount rate or in the initial cash outflow or outlay. Let's conclude our discussion of this weighted average cost of capital, or we can say the required rate of return and the cost of capital. The main purpose is to create value for the shareholder, or creating value for your firm. And what is this value? It is an economic value added, and it usually measures the business performance, because it is another way of measuring the firm's are earning return on their invested capital that exceeds their cost of capital. So let's suppose if the company has utilized the debt instrument, the equity and the preferred stock, and they have earned, let's suppose $10 million of profit. And let's suppose if they have to pay the cost of capital of the borrowed amount as 8 million, then the resultant value is telling us that this company has generated an economic value of $2 million to the company and as well as to the shareholders' wealth. How to do that? The simple formula is to economic value added is equal to net operating profit after taxes, which is an accounting profit, or net operating profit after taxes. We have to subtract the cost of capital multiplied by capital employed. Let's suppose the cost of capital was 9.95% as we have discussed, and the capital employed was $100 million. So after subtracting the additional cost of capital from net operating profit after taxes, if there is certain leftover amount is positive, then definitely the economic value addition has been done in the company. Otherwise, it is not. What is this NOPAT, or net operating profit after tax? Is a company's potential tax profit if it was all equity finance or totally unlevered company. So we have to adjust or subtract the additional cost of capital of utilizing the debt or a preferred stock, so that to come up with either the company has created economic value for the investor, for the company and for the shareholder or not. So since a cost is charged for the equity capital also, and if the resultant value after this subtraction is positive, then the economic value has been added, and generally it indicates that the shareholder value has been created. So therefore, our prime emphasis will be on the economic profit, not the accounting profit, because the accounting is usually based on an accrual basis. However, after paying all the charges to the company, that is cost of equity, preferred stock and as well as the debt instrument, if still there is leftover amount, then we can say that an economic value has been created for the shareholders' wealth. So this was all about the main crux and idea about the required rate of return and cost of capital, and what are the different advantages of discussing and utilizing the phenomena and the theory and mechanism involved in calculating the cost of capital for the different sources, that is debt, equity and preferred stock. Thank you very much for listening to this lecture. If you have any question, you are free to ask your question on KCMS, and as well as you can send your queries on my official email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.